Hello everybody, welcome back to Clear to Serve Financial Education. Carl Keister here. So first public service message, wear your sunblock out there, especially in South Florida. I have some things removed, as I mentioned in the last video as well, I'm a dermatologist, so please wear your sunblock. It's dangerous out there. Okay, now I want to get into SPACs. This is what I mentioned in my last video. I saw individuals in these chat groups talking about buying SPACs, and I saw some of the SPACs have literally gone from $10 to $20 or even $25 in a month. So when I see something that's getting 100 to 150% return, it draws my attention. So I did some homework here. So please like, subscribe, and share this video, and that would definitely help out my channel as far as the algorithm goes. So thank you. So first of all, what is a SPAC? It is a special purpose acquisition company or a blank check shell company. And how this works is if you've got individuals, maybe mostly hedge fund managers and big mutual fund managers, people that are very wealthy or have a lot of knowledge in a certain field, they raise money and they create this corporation. It's a publicly traded company, but there's nothing there. The money goes into a blind trust with the intent of going out and acquiring or merging a company that may be publicly traded, or maybe it's not publicly traded yet. So where this comes into play is you have companies out there that may want to go public, but they're not quite sure which route they want to go. The traditional IRA takes a long time. It can take anywhere from 2 to 3 years for a company to get the paperwork in order, go through the procedures, and actually launch themselves and go public. And then you never know what's going to happen in 2 or 3 years, whether they're going to get the price that they wanted. So it makes it a little bit more risky for the company that wants to go IPO and go into the market and raise some more money. So how does this affect you? In order to get to that, I want you to stick around because I'm going to get to how it affects the retail investor towards the end, but I want to give you some definitions and what this means to institutionals and also to you. So yeah, we'd all like to make 150%, 100% of our money in 1 month, but I want to explain to you the risks and why some of these things might not make sense. So first of all, why is this happening? So you've got really cheap money out there. The Fed's got interest rates low. There's more money out there trying to find a home. And so this is creating a need or a renewed interest in these SPACs. So Bill Ackman, for one, raised $4 billion July of 2020. I looked the other day, it's almost up to $6 billion now that he's raised with intent of going out and merging or acquiring other companies. Now, the thing about a SPAC is you only have 2 years to use the money. So institutions that give him money pretty much write him a blank check and say, okay, Mr. Ackman, go find the company that you think you can, take it to the moon, take off. So what he does, he raises the money and he goes out and tries to talk to these companies about possibly going through a merger with him. Now, why would they do this? Well, first of all, generally say it takes 2 to 3 years to go public normally. If you do a merger with a SPAC, a company that wants to raise money can actually do this in 3 to 4 months. So big advantage for them, it takes less time. It is a little more costly for them to do it, so that's one of the downsides, but you know exactly what you're getting for it because you negotiate that. The company that's being acquired will be negotiated. They would know their price, they would know what they're getting, plus they may get help from this management team, which may have extensive experience and knowledge in what you're doing, what you're trying to accomplish. So therefore, it makes sense. You get maybe a board member or two that can help you grow. You get this influx of money, and the merger, the IPO, basically only takes 3 to 4 months instead of 2 to 3 years. So in a nutshell, that's how it works. Now, I'm going to stick around because I want you to listen closely. For a retail investor, there may be some downsides to this, but I have one more example I want to show, which I think will make sense. You have Social Capital CEO. They launched 6 SPACs in 2019. And their intent is to take 26 companies basically public or merge them. So one of the first ones he did was last year. They took Virgin Galactic, Sir Richard Branson's company. They did a merger through a SPAC. So this was already set up. It was offered at $10 a share. And wow, this is really good for Virgin Galactic because they can do this merger in 3 to 4 months instead of 2 to 3 years. And he also gets an option. Anybody that invested in the SPAC would get a $10, would it cost them $10 to invest in it, plus they get warrants. So if the company takes off, warrant is an option to buy a stock at a set price. Maybe a stock was the shares were at $10 a share. the warrants may be $11.50. If the stock goes public and runs to 15, 20 bucks, they get the right to buy that share for $11.50 a share and to turn around and sell it immediately if they want to at 15 or 20. Huge moneymaker for the people that invest in these things. So they have these institutions that do this have very little risk. They have big upside. Plus, if the SPAC does not use the money within 2 years, the investors get their money back. So they have no risk if they don't make a merger within 2 years, but they have these huge upsides if they actually buy a company like Virgin Galactic went from $10 to $30 in the first couple months. So huge upsides for institutional investors. So the reason why I'm bringing this up, I saw a lot of people on some of these chat rooms I watch and some of these investment channels I watch who are jumping on companies like CCIV. That's the one I mentioned. It went from 10 to 20 bucks in a matter of a month. Now it's starting to fade back a little bit. Why I bring this up is you want to be careful. These institutions have the option with these warrants to buy shares at a lower price. As a retail investor, you do not. So of this research, and this is why I say I spent a lot of time researching this, please like, subscribe, and share to get these answers for you. So basically, as a retail investor, you do not get warrants. So once this thing goes public, you can start trading it, which is good. It's a good side and bad side. If you're an IPO, company goes IPO, let's say Chewy went IPO, you can't get that as a retail investor. Very few of us can. Only the really big money players and the big institutions have those shares. So you have to wait till it goes public, and often it skyrockets and it's out of touch. The whole purpose of the SPAC is you get in at a cheap price, but you don't have the option to say, no, I don't like the deal like the institutions. The institutions, if they don't like the merger, can say, no, I don't want that. I'll take my $10 a share back and walk away. They had no risk at all. As a retail investor, you're buying and you don't have the ability to say, I don't. So the stock goes from 10 to 20, fantastic, you got lucky. Right now, if you bought it at 20 and it goes back to 10, you lost 50% of your money. So that's the thing about the SPAC. You want to be very careful. I looked into several of these and some of them have taken off, but you don't have the recourse of saying, no, I don't like the company they're going to buy and I'd like my money back, or the option to say, I've got these warrants over here and I'd like to buy that share. It's sitting at 20 bucks a share. I'd like to buy it for $11.50 as the institutions do. You don't have that option. So very important differentiation between investing in a SPAC as an institution versus investing as a SPAC as a retail investor. So my advice for you is be very careful if you think about buying into one of these ticker symbols, and make sure if you hear it's a SPAC or you see something that's moved up 100% in a month, look into it, because if it is truly a SPAC, it doesn't mean it could be nothing right now. It's a blank shell company where they're just gathering money to one day make a merger. DraftKings is another one. You know, DraftKings, now that stock is going through the roof. So if you bought that as a SPAC and you didn't like the acquisition as an institution, you can back out of it. As a retail investor, you're kind of waiting until it goes public, and a lot of the upside has already been taken out of it. But buying these SPACs as a retail investor, you and I, there's a lot more risk and a lot less benefit. So that's something. And also one thing too I want to point out, I read into this. So when these people sponsors, when they gather these SPACs, they form these SPACs, they get 20% of the they call them founder share. 20%. So they invest $25,000 and they get to keep 20% of the share. So if they go and raise $100 million, you know, that's a ton of money. They're making multi-millions of dollars regardless of whether the merger works or not. So the institutions or the people that buy into it can back out, they're protected. The people that form the SPACs can actually make hundreds of millions of dollars, in some examples, tens of millions of dollars, even if the merger fails. So it's a win-win for the SPAC, it's a win-win for the institutions, but for retail investors, very, very risky. With that being said, you might want to look into some other things. Maybe like I mentioned, let's look at SpaceX. I mentioned that was one of the first ones that was done by Social Capital. So I'm just going to pull up a chart here quick. I'm going to look at my screen, pull up a chart, because this is one that has been out there now for a year. So again, initial public was trading at $16, $18 a share, ran up within a week or two to 42. So 18 to 42, and then collapsed all the way back down to 13. And now it's drifting back up to 30. So just be careful. But I would say, for those of you out there that like to pick and choose stocks, you may want to keep track of these SPACs that raise money, and as soon as it becomes public of who their target is, say it's a SpaceX or it's a DraftKings or something like that, I think there's an opportunity. Is once it's made aware that the SPAC is going to take this company public, well, now you're in the public market, there's millions of shares being traded, reduces your risk. So if you get in early on, and especially if you get in the first couple of days, a couple of weeks, that you have an opportunity to make some decent money, but not always. There's some stocks that go to the moon right away. Affirm was one of them, went public IPO here last week, and the day it went public, I think it was public at 40 bucks a share, it went to 110. I saw today it's at 25. So chasing IPOs, very dangerous, very difficult. SPACs, be very careful. If you don't know what you're buying, make sure it's not a SPAC. That's all I have to say, because if you're not an institution and you're not buying in at that level where you get the option to buy the units, option to buy the warrants that you can get out of, or if you don't like the deal, or warrants to give you more shares when it pops, you're pretty much at the will of hoping they made a great acquisition if you bought in as a SPAC. With that being said, I'm going to leave it there. So please like and subscribe, and hopefully this helped out. Also, I want to mention in my last video, I watched the Wall Street Bets. I told you there was a short squeeze on GameStop. I'll leave links to that. It's been a very interesting stock. Yesterday, again, it fell down and then popped $5 intraday. It was a heck of a move if you're watching it, and you can make some quick money on that, but be careful. But again, these guys are pushing stocks. I looked this morning and I couldn't figure out why Ford went from $9 last week to $12 today. And I looked on the one of the chats I follow, and they were on there chatting it up. 1.9 million people in there talking about this. And as of earlier, I saw 143 million shares traded hands by 11 o'clock today. So hour and a half of trading, 143 million shares of Ford traded, and a lot of this trading is coming from chatter, once again, on these Reddit sites and other sites. So be careful out there, but if you're following the volume and you want to jump on board for a quick trade, it may be there for you. Okay, until next video, take care.